Hi, Ron Benning, real estate investment expert, and today I'm here to talk to you about some opportunity that the market is presenting to us right now. For months, it seems like we've been barraged with nothing but bad news, and with interest rates going up, it seems like how could we possibly still buy any of these properties and have it make any sense? Throughout history, during periods of uncertainty, there has been unprecedented opportunities. Right now, a lot of people are pulling back from the market because they're only looking at the traditional ways of doing things. Over the last few years, there's been so much competition on properties. Many of you have been outbid. Many of you who successfully bought properties had to go way over the asking price. Now, today, because of the higher interest rates, there's much less competition. The inventory has went up by about 40% in most local markets. The challenge has been that because of the interest rates, the payments just don't make sense. Now, a lot of whether this special opportunity is going to work for you has to do with your outlook about what you think is going to happen with interest rates over the next few years. It's my opinion that there's a high probability that we're going to be seeing high interest rates from 12 to 24 months. If you believe that this is the case, this special program that I'm about to talk about probably is going to make a lot of sense for you. If you believe that interest rates are going to be high for the next 5, 6, 7 years, then it probably doesn't. There's a lot of special little changes that can be made to this program depending on your circumstances. And for example, we have one option where it's fully amortized. We have another that's an interest only. In our current market, the goal is to be able to buy a good property and make it make sense while we're waiting for better interest rates. So I'd like to say that we marry the property, not the interest rate or not the loan. So for the purposes of this discussion, I'm going to focus on the interest only option. Now, as of the time I'm making this video, the fixed rate mortgages for multifamily properties are hovering between 6.5% and 7%. So it's made it a real challenge to try to have anything but a pretty significant negative cash flow. The program I'm talking about, it is going to be an interest only. If you choose an amortized version of it, the interest rate is going to be slightly lower. But remember, the goal right now is to just keep the cash flow reasonable while we're waiting for better interest rates. So for the sake of argument, this program starts at 4.25% interest only. So what does having interest only do compared to paying it off through a fully amortized loan? Well, in the short run, obviously you're not paying off any principal. But during a period of high interest rate, we can keep the payments more reasonable while we wait for those lower interest rates. Now, how does it work? It's based on an adjustable rate mortgage. And I know a lot of people are going to get real nervous about that all of a sudden. But hear me out with how this works. The initial payment is fixed for 6 months. Then after 6 months, it could go up as much as 2%. After the initial adjustment, it could go up as much as 1% every 6 months with a lifetime cap of 5%. And here's where it really makes sense. When you look at these programs objectively, unemotionally, and you say, well, what happens in a worst case scenario? What happens in a best case scenario? If you're in the camp that believes the interest rates are going to be high for 12 to 24 months, this is a no-lose situation for you, and here's why. If you look at the rate that we can get you on a 30-year fixed rate today, you're looking at between 6.5% and 7% on a multifamily transaction. This is starting 3% lower. So what is important is to look at how could it go worse or how could it go better. The index is the base rate, and then the adjustment is based on adding a margin, which is 2.75. To make this a little bit easier for you to see, I'm going to go ahead and I'm going to jump onto a share screen. So you'll see a little bit smaller version of me, but the information will be a lot easier for you to see on the screen. I went to the newyorkfed.org website, which is the Federal Reserve Bank of New York. And they're talking a little bit about the SOFR averages and index. And offline, you can do a little bit more research into how this works, but it's easy to find this index. To illustrate how this will work at the end of the first 6 months for the adjustment, today that I'm making this video is July 26th, and the 30-day average was 1.52. So if today was your 6-month adjustment, we would take this 1.52 and we would add the margin to the index, which is 2.75. And if we had started this at a 4.25 and the 6-month adjustment, we would have a new rate of 4.27. In this case, it would have went up 0.02%. Now, if we take a look back approximately a month and we see that at that point, that was probably prior to or right about the time the last rate increase, we had a 1.01. And if we had added the index to that, 2.75, we would have come up with a 3.76 range. Now, let's say that the Fed makes another increase to the funds in the next meeting in a month or two. So in that case, let's just take this current rate and let's add another 1% to that. And if it was adjusting at that point at the 6 months, we would be at the 4.27 we would have been, plus 1% is 5.27. Let's take another example, and let's say that after that initial hit, after that initial adjustment, that at some point over the next year, the Fed raises rates to where this index goes up 2% more. If we take the information on 7/26 and we add 2% and the 2.75 margin, we're going to be at 6.27%. So if you believe that the interest rates are going to go up more than 2% in a way that would affect this index more than 2%, this is probably not a good loan program for you. But for it to be worse for you, it would have to be more than 2% higher than the interest rates are today, as of this filming at the end of July. And keeping in mind that the current interest rates on fixed rate mortgages that we're seeing out there on the traditional loans are 6.5% to 7%. So there's a lot of things that would have to happen before you do come out worse off. Having said that as well, because you will have been paying less payments for 6 months, a year, 18 months, or 24 months before these worst case scenarios could come out, your cumulative payment over time is likely to be a lot less unless we really just have a nightmare scenario where interest rates go up another 4, 5, 6%. But even if they went up 6%, the lifetime cap is 5%. So like any opportunity, there's a little bit of risk. But I think once you really understand the way this index works, I think that this is a very great solution for people who think that the rates are likely to be the same or lower than they are today, a year and a half or 2 years down the road. Because if the rates don't go up, your interest rate on the adjustable rate mortgage will not go up. I've had an adjustable rate mortgage on my property, my primary residence, for about 10 or 12 years. And for me, it has been a great savings of interest over that time. I know it's not for everybody. So based on the information that we've just went through, if you believe that the interest rates are going to be high for a year or 2 years, and then we will see a little bit lower rate, you really can't go wrong with this program in that time frame. We can keep your cash flow a lot better. And in this period of time, when we're seeing increasing inventory, we're going to be able to get you better deals. In our current market, we're not getting prices way under the ask yet. But we might find in the months to come that using a program like this, Buying when others do not see opportunity will allow us to pick up some bargains. It'll allow us to position ourselves to where maybe we're just breaking even or doing a little bit better than breaking even today. But when the interest rates go back down, we married the property, not the financing, and through a refi, we can get you down into a really solid position at that point. If this program looks interesting to you and you want to find out more details and you want to see if we can get you pre-qualified for this loan, reach out to me or the member of my team that you're working with, and we'll get started.